because you drove a Hyundai to get here tonight. I drove an $80,000 BMW. That's my name.
Hey guys, and welcome back to another video. So recently, financial planners have been saying that real estate is the top passive income source. Why, you ask? Well, stick around to find out. First, we're going to talk about who financial planners are and why they are credible sources. Then we're going to talk about what a passive income source is. Then we will connect them to real estate, so who do you get to know the full picture? So stick around till the end of the video to find out why these guys are saying this and why you need to listen to them. So who are financial planners and why would you listen to them? A financial planner is a trained investor advisor who assists people and businesses in achieving their long-term financial goals. Financial planners help customers by analyzing their goals, risk tolerance in life or corporate phases, and then recommending an appropriate investment class. They may then advise a strategy to assist the client in achieving those objectives by spreading their available funds among a diverse group of investments meant to grow or generate income as desired. Tax planning, asset allocation, risk management, and retirement and/or estate planning are among areas in which financial planners may specialize. For customers to trust financial planners' advice, they must have appropriate education, training, and experience. A practitioner may acquire and carry one or more professional designations as proof of their qualifications. Fiduciaries are financial planners who expressly give financial advice and handle money for customers. This means they are legally bound to work in the best interest of their clients and they cannot profit personally from the management of their assets. Rather than managing these assets for their personal advantage, they are expected to manage them for the benefit of the customer. The details of fiduciary relationships might differ. For example, under the Investment Advisors Act of 1940, registered financial advisors (RIAs) are fiduciaries who provide investment advice to high net worth clients. The Securities and Exchange Commission (SEC) or state securities authorities supervise them. Many IRAs function on a fee-only basis, which means they can't work on commission or sell clients financial items that aren't in their best interests. The business model does not need financial planners to be IRAs. Fee-only financial planners typically charge an hourly rate, an annual fixed retainer, or a portion of investment assets they manage on their customers' behalf. Over and beyond any broker or dealer, they owe a fiduciary obligation to their clients. Commission-based financial advisors typically get money from the firm whose investments product they promote. They can also make money by helping clients open accounts. Now, what is a passive income source? Well, earnings from a rental property, limited partnership, or other business in which a person is not actively participating are referred to as passive income. Passive income, like active income, is typically taxed, but the IRS treat it differently. Active income, passive income, and portfolio income are the three primary types of revenue. Earnings from a rental property, limited partnership, or other company in which a person is not actively involved, for example, a silent investor, are examples of passive income. Passive income proponents are often supporters of a work-from-home and be-your-own-boss professional lifestyle. In recent years, the phrase passive income has been thrown around a lot. It's been used colloquially to describe money obtained on a regular basis with little or no work on the part of the recipient. The IRS defines passive income as either net rental income or revenue from a company in which the taxpayer does not materially participate, and it can include self-charged interest in some instances. Self-charged interest rental properties and companies in which the individual receiving the money is not a major participant are examples of passive income. In order for income to be deemed passive, there are particular IRS criteria that must be fulfilled. Self-charged interest. The interest income on a loan to a partnership or an S corporation functioning as a pass-through organization, basically a business structure to avoid the impact of double taxation by the entity's owner, can qualify as passive income. If the loan funds are utilized in a passive activity, some self-charged interest income or deductions may be regarded as passive activity gross income or passive activity deductions, according to the IRS. Rental properties. With a few exceptions, rental properties are considered passive income. Any rental revenue you earn as a real estate professional qualifies as active income. If you're self-renting, which means you own a space and rent it to a company or partnership where you do business, it's not considered passive income unless the lease was signed before 1988, in which case it's considered passive. It makes no difference whether the usage is under a lease, a service contract, or some other arrangement, the IRS said. Land leasing revenue, on the other hand, does not qualify as passive income. Despite this, if the property generates a loss during the tax year, the landowner might benefit from the passive income loss regulations. no material participation in a business. If you invest $500,000 in a candy store with the understanding that the owners will give you a portion of the profits, it is considered passive income as long as you do not engage in the running of the business in any meaningful way. Because you offered substantial involvement, your income may be considered active if you assisted the owners in managing the business. So why is real estate one of the top passive income sources? According to financial advisors, the most common source of passive income for their customers is real estate. Insider talked with a number of financial advisors asking them where their customers' passive income comes from. Real estate is one of the most prevalent types of passive income they encounter among their clients, they said. They did point out, however, that not all of their clients are property and apartment managers. Instead, they use two additional techniques to generate passive revenue that are less time-consuming. Rather purchasing their own property, some investors opt to purchase shares in a bigger real estate portfolio. Several of Incline Wealth's clients invest in real estate this manner, according to financial advisor John Bovard. These real estate investment trusts, or REITs, come in a variety of shapes and sizes. While other investing platforms offer REITs, Bovard's clientele prefer non-listed REITs that pay a monthly dividend. Clients put money into the REIT and the business handles the management. The firm is going out and buying these massive real estate holdings. Then my clients will deposit $100,000 into the fund, which will be locked up for a year, he stated. They get a monthly income from that fund and also own a piece of the underlying real estate. They can also profit from the rising value of real estate, he stated. These non-listed REITs are only available through a financial advisor and have minimum income and net worth restrictions. However, there are publicly traded options that pay out quarterly dividends. In any case, REITs can assist create passive income without requiring direct ownership of real estate. Brent Weiss, a financial advisor and co-founder of Facet Wealth, said his customers are generating passive income from their houses. House hacking, which entails purchasing a property with a rentable room or separate apartment in order to generate passive income, has become a popular technique for his customers to profit from real estate. I'd say half of my customers have changed their minds about real estate, he added. How do I go about purchasing a home for me and my family? Then how am I going to rent out that additional shed in the rear with a complete kitchen and everything? It's a good approach to start earning passive income from real estate, according to Weiss's experience with customers. While it will still need some landlord effort, it may not necessitate a significant additional expenditure. If you're still not convinced, even there are a lot of resources on the net that can help you find out more. Even more, you can get a personal financial planner so that you can get personalized advice, which we can obviously not do. There are also some resources that can help you find the perfect financial planner. Here are some questions that you can ask while interviewing your financial planner. What are your credentials? Can you provide references? What do you charge? What is the area of your expertise? Will you act as my fiduciary? What services can I expect? How will I settle disputes? Expect good answers and cross-check the resources, and after all, you're putting your financial life in the hands of this person. To check the status of a CFP and for a guide on choosing the right advisor to work with, visit the CFP Board of Standards website. And that's all for this episode, and we really hope you learned something new today from this video. If you did, tell us down in the comment section, as it makes us feel good and motivates our team. If you enjoyed the video, remember to subscribe if you already have not, and like the video. It takes 5 seconds of your time, but each and every one of you means a lot to us. Until the next video, take care and goodbye.